Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Monday, November 21st, 2021. It's great being with you here today. We're going to talk about leading indicators. Later on Friday, we got the news. We saw another precipitous decline in leading indicators, now down 2.7% year over year. What are the leading indicators? There are 10 of them. We look at them and they together, their aggregate uncertain weightings with all the fun econometric mix thrown in, give us an indication of what the economy looks like over the next 6 months. Yes, we have coinciding indicators. We have lagging indicators. Those often tell us where we are, whether we're in a recession or not, or the lagging, have we been in one and are we not? The leading indicators look ahead. And this has been the question that people are arguing about. Are we going to have a recession in the next 6 months? According to the Conference Board, with all their econometric elements indicated, they are saying yes. We are seeing a drop in confidence. We saw a drop in the new orders. We saw a precipitous drop in permits. Now, at the same time, the credit environment is weak, particularly because short-term rates are above long-term rates. So yes, maybe the market's been a little better. And that's kind of where the rub in this whole argument is. The market is generally considered a very good forecaster over the next 6 months. It's been through a rough spell. We're seeing some earnings momentum that's actually looks to be building both on the industrials and even the energy side of the equation. And even today, we got management changes. Disney brought back an old-time CEO, had been very successful for the company, and maybe that can refocus the mix of a company that's been a little wayward as it's gone through the pandemic. Yes. Are these management elements, are these earning elements like we've seen in the FANG stocks idiosyncratic? Are they focused on company issues? Are they cyclical? Are they looking at the elements of the economy? I would argue, this is 20 years of being a portfolio manager and following equities, is that they're more idiosyncratic, that the economy and how the market perceives earnings are actually going to be pretty strong. And as we get the second reading for the GDP for the third quarter, we will get even more information on how corporate profits, not just the S&P, but how the corporate profits of the country will work. And importantly, remember that company, particularly on its debt, have lots of flexibility. So higher interest rates are not a recipe to disaster. So as we look forward, what do we want to see? Who's going to win? And what type of recession this will be? Yes, it does look like we're going to weaker economic growth. But does that mean that consumption, and we'll just look at goods sales or retail sales, does that mean that 700 billion per month goes to 650? Remember, we started at 520 before the pandemic. So what does that mean? And since we have this new medicine of stimulus, how quickly is that put into the economy? And what is the ramifications of that as it works through the cycle? I would generally state at this point that because of the corporate strength is that it'll be mild. And politically, I think there's a desire and a will to help out if necessary. And so looking forward, yes, we should have a mild recession. And with that recession, we will reestablish elements like inflation and pricing that will push us forward to an even better expansion. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me here today.